Welcome back to the channel. Like always, my name is Jose Najarro and I am a self-taught investor looking for investments to grow my long-term portfolio through fundamental analysis. I am very excited about today's episode, and lately the past two episodes I've been talking about AvePoint and APXT, which is the company that's going to merge with AvePoint to bring AvePoint public. In my past two episodes, I've been kind of, I want to say, bullish with that company, but as a long-term investor, it's always good to know both sides of the story. It's never good to just close your mind and understand only the bull case of the company. So today's episode, I actually want to take a look at the bearish case of this company and take a look more at what are some of the high risks that come with buying or owning this company. But before we start with today's episode, make sure to smash that like button. It helps so much with the YouTube algorithm and I truly appreciate it. Also, on the description and the pinned comments, you should see a link to my Discord channel. It's free to anybody that wants to join. We have over 1,000 members. I post every time I buy and sell there, and like I mentioned, it's free to anybody. Finally, you should also see a link to webull.com. If you sign up and deposit $100, we both get a free stock. I think right now they're doing a special. We might get 2 or 3 free stocks. It'll definitely say when you sign up. All right, so like I mentioned, right, today we are going to take a look at APXT, and I do believe this will probably be my last video on them for some time. If you guys haven't checked them out, I did the first video, which was more of the fundamentals of what the company does. Then I took a look at them and some questions that viewers were having. And now in this episode, I'm going to do more of a bearish case scenario, in my opinion, just see some of the risks that come with it. Like I mentioned, it's always good for any investors to know both sides of the story. Understanding both sides of the story doesn't mean you have to jump to the other side, but always understanding the risk is such a great thing about owning a company, right? It's always good to understand what would be the things that run this business run this company out of business. What are some of their biggest threats right now? So if those threats do come in hand or do come in the future, we understand how to deal with them or what would happen in that scenario. So there are 6 risks that we're going to take a look at first. And the first risk is pretty simple. This is a SPAC deal. So risk number 1, SPAC deal. So what does that mean? Since this is a special purpose acquisition company and they're not expected to close this acquisition until Q1 of 2021, there is a risk that this merger might not happen. If this merger does not happen, most of the time with the SPAC deals, they have a price that it returns back to. So right now, I do believe the price, I could be completely wrong, would be $10. So right now it is sitting at $14. So there is that risk of losing that money because the transaction does not happen or the merger doesn't happen. Anything can happen within now till when the merger is expected to close. So it's never a guaranteed deal until the final papers are signed. And I do want to appreciate 2 people that kind of posted on my YouTube comments earlier today, and they kind of brought some great points to this, and we're going to mention some of them. The first one was by Weelon, and he mentions there seems to be some red flags on the company, like how it has been in business for 10 years and only capturing 3% of the market shares. This is one of the topics we are going to talk about. And the other one is going to be Timo. He mentioned that AvePoint is definitely one of the weaker companies out of the 5. He's kind of mentioning right now that AvePoint, in one of their presentations, they mentioned that there's only 5 software companies right now that are seeing strong revenue growth, that are positive earnings before interest and taxes, and that are also making over $150 million in revenue. And he's saying that they don't belong in that category. So we're going to take a look at those questions. So I do appreciate this. And remember, I'm not one that would get mad about someone having a bearish case in any of the companies I own or in any of the companies I'm looking at. I personally like it because it helps me see the other side of the story. And as an investor, that's the greatest thing, coming in with an open mind, trying to understand others' response and others' thought process in a company. But before we go any further, guys, don't forget to check out my second channel, Jose Najarro Entrepreneur, where I pretty much post videos of becoming successful or making money outside the stock market. So remember, that's Jose Najarro Entrepreneur, and I truly appreciate the support. So risk number 2 is like we saw with one of the YouTube comments. It's not in the league in the same league as all these other competitors. So AvePoint mentioned that there's only 5 companies right now, Atlassian, RingCentral, ServiceNow, ZoomInfo, and Zoom, that are making over $150 million in revenue, that have 25% revenue growth, and that have over 10% margins in earnings before interest and taxes. And the reason he considers them not in this same league, and I checked it, is that AvePoint is the only one for this year making close to $150 million. The second one is going to be ZoomInfo. ZoomInfo is expected to make about $500 million, so about 3 times the size of AvePoint. And all the other companies here that we're looking at right here are all making over $1 billion, $2 billion in revenue. So obviously you would expect that kind of revenue growth for companies a lot bigger, but he's saying, hey, for AvePoint, if you're only seeing $150 million in revenue, I want to see a lot more growth. And that's completely understandable. So this is risk number 2. Even though they are in that category, I wouldn't say they're in the same league as those other companies. Now comes risk number 3. Risk number 3 is volatility. Like I mentioned, this is a SPAC deal. So with that, it's going to come with a lot of volatility. We're going to see crazy updates like we saw on Friday, where it was 30% days. And after hours is up another 8%. So volatility works both ways. We can see strong bad days as well. I wouldn't be surprised if we see a single day of down 10%. 15%. Those days are possible with volatility, with the volatility this company is bringing, especially as we get closer to the merger. If it happens, if any bad news come throughout that process, it's gonna make this a wild ride. So I do want to say risk 3, volatility, is a risk. And this is a risk for those that have weak hands. If you have weak hands, what happens is you end up selling in those bad days and end up losing money. So volatility in the whole thing, I don't ever consider volatility a risk. It's part of the game. But I do believe that there's many people that make it a risk because they have weak hands and end up selling when they see a 10% drop day. And as long as one needs to understand that those types of days are not impossible, especially with a company like this. Risk number 4, someone mentioned it. How is it possible that this company has been in the market for over 20 years, partnership with Microsoft, and they're still only hitting 3% of the market share? This shows that they're not that great of a company. So that would be the case. I actually, this is a one to understand. I actually agree with all the other risks that I saw, but this one I honestly don't consider too much of a risk. And the reason is, this would be true if the total addressable market was flatline, right? If the amount of Microsoft 365 users have been flatlined since the beginning of the company, since the beginning of AvePoint. But that is not the case. Microsoft 365, as we see in the Microsoft earnings, those users continue to grow and grow and grow every quarter and seeing strong growth. So if the total addressable market share is increasing at faster levels than new customers of AvePoint, then obviously that total market share that they have right now is going to be a small portion, right? We're still seeing an increase of total marketable shares, and we're also seeing an increase of AvePoint users. Even though you're seeing an increase of AvePoint users, that total market share is not going to move much. It might actually even decrease depending on how fast Microsoft 365 is growing. So, but again, it's something to take a note of and understand what's the risk there. Number 5, Microsoft dependent. And this one is actually one I do consider a risk, but I kind of wrote it off. And the reason why, Microsoft dependent. Most of this company's revenue comes from the ability to bridge those Office tools to whatever enterprise needs. The reason I wrote this off is for over 20 years, they have been working with Microsoft. Microsoft has given them plenty of partnerships award. I think for the past 5 years, they've had like best partnerships with Microsoft. Right now, AvePoint is also has one of the biggest research and development for Microsoft tools outside of Microsoft. So if they've been working so well for the past 20 years, this shows that they have that strong partnership. And right now with a public company like this, if Microsoft, I'm not expecting Microsoft to go down anytime soon. So that risk of being Microsoft dependent is not one I see in Microsoft's side. And what I can actually see happening is in the future, as this company continues to go public, you might start seeing Microsoft or some form of trust by Microsoft Corporation start to buy some form of ownership into AvePoint, and that's personally what I see. But again, it is also, one should understand that this is all Microsoft dependent based on their Office tools. But based on this partnership, I don't see them breaking this bridge down and saying, AvePoint, we don't need you anymore. Instead, what I would see happening is, hey, this bridge is helping us grab new customers. I'd rather buy this bridge than cut off this bridge and make my own bridge, right? That's how I see it. And I feel like many business owners would see it that way. The final risk that I see that many people might have mentioned is weak growth, right? We can see year-over-year annual revenue growth. In 2019, quarter one was 18%. In 2019, quarter two was 19%. Quarter three was 23%. Quarter four was 25%. In 2020, quarter one, which was almost the beginning of COVID-19, there was a 27% growth. And in quarter two of 2020, which is already during COVID, they saw 29% year-over-year annual reoccurring revenue growth. What a lot of people are saying, hey, this is during COVID section. Why did we not see stronger revenue growth during this time? A lot of other SaaS companies saw that kind of growth there. Why are we not seeing it here? And I honestly, that one is one I actually believe might have some truth to it, and one I have to keep an eye on some more. The only thing I want to say is, mainly due to this product that AvePoint owns, is something that all these companies that have been using Microsoft 365 already have already incorporated. It's not something that they would have incorporated due to COVID situations. So that's the only thing I'm seeing. But regardless, we are seeing revenue growth increasement every year, every quarter compared to the same quarter last year. So these are the CIS risk of the companies that I see right now. Again, this does not bring me a bearish sentiment on the company, but it's great to understand the other side of the story. So I hope you guys enjoyed today's episode. Like always, make sure to hit the thumbs up. Make sure to smash that like button and let me know in the comments, did you guys like that I switched things around, that I brought a bearish case instead of the previous two videos where I brought a bullish case? So take care, guys, and good night.